Welcome to my channel. I'm going to show you step by step how to value a stock. The first thing we do is enter the financial information into my discounted cash flow model. We then add the company's debt and equity details to figure out the discount rate. Finally, we determine if the stock is a buy or a sell. We then look at the financial ratios and compare them to its competitors. I'm going to walk you through the entire process so you can do it on your own after watching this video. Make sure to leave a comment if you have any questions. The company we're going to look at is Horizon Therapeutics. And Horizon's drug portfolio is focused on treatments for arthritis, pain, and inflammatory diseases. In 2014, it moved its headquarters to Ireland to save money in taxes. But its main operations take place in Chicago. Let's get started with the model. This company has a market cap of $14.6 billion. So it's a large cap company since its market cap is above $10 billion. And it's trading at $74.48. It's up 21% today. That's why I'm doing this video. So the share price, $74.53. We'll put that into the model. Let's pull their free cash flow. So free cash flow is cash flow from operations minus capital expenditures. That's how you value a company, is you estimate the future free cash flows and you discount that number back to today's value. That's what we're doing in this video. And now I'm going to pull the net income, which is the profit and loss on the income statement. And 3 years they had negative net income, which means they had negative profit. But yet they had positive free cash flow for those 3 years. The income statement uses accrual accounting, so there's a lot of non-cash items that get passed through. Let's pull the revenue, which are the sales for each year. So you can see that sales have increased every year, which is good. And I use the analyst expected future sales numbers for 2020 and 2021 because it seems like the expectation of the future is going to be more than the company's been generating in the past. Now let's look at the capital structure of the company so we can figure out the discount rate to apply to the future cash flows. The interest they pay on their debt is $87 million. And to get their debt, we'll go to the balance sheet, we'll go to the liabilities section, and they don't have any current debt. Long-term debt of $1.4 billion, that's debt due after 12 months. And according to the income statement, they don't pay taxes, probably because they moved to Ireland, so they saved money there. So let's get the beta now so we can figure out the cost of equity. And the beta is how volatile the stock is relative to the market. The market as a whole has a beta of 1. This is a beta of 1.22, so the stock moves a little more than the market. And we need a little more information on the balance sheet, because when we calculate the current ratio later, we need to look at their current assets. Current assets are assets that can be liquidated into cash within 12 months. And that's $1.7 billion. Let's see what that is. That's $1 billion of cash, $408 million of net receivables. Net receivables are accounts receivables minus the accounts receivables the company does not expect to receive. So net receivables is more of an accurate depiction of their receivables. And they have $53 million of inventory. Let's get their current liabilities. This is how much money the company owes within the next 12 months. That's $723 million. And that's $21 million of accounts payable. This is the money the company owes creditors and suppliers. And accrued liabilities is $656 million. So when a business incurs expenses, but it has not yet paid those expenses, it books them into accrued liabilities. So payroll and payroll taxes are common types of accrued liabilities because companies book them one period and then pay them the next period, so they reverse out the accrued liability. Let's get the stockholders' equity. That's the value of the company according to the balance sheet, and it's $2.2 billion. That's total assets minus total liabilities. And that's common stock, which is $19,000. Common stock is a stock that's trading on the market, but it doesn't reflect the actual stock price. It's just an arbitrary price they put onto the stock, like a penny per stock. This way they can track it on their balance sheet. They have retained earnings of negative $600 million. That's a sum of all the prior net incomes minus all the prior dividends. Good companies have a positive retained earnings. This indicates a company has not been operating at a profit in the past. Accumulated other comprehensive income are unrealized losses on its investments of $1.9 million. So they have not sold the investments, so it's unrealized. Once they sell the investment, it becomes realized, and they have to actually book the loss onto the income statement. Let's look at their operating income. That's how much money the company earns through its operational everyday business. That's $138 million. We need that to calculate the interest coverage ratio later. Let's look at the capital structure. 38% debt. The cost of debt is 6.5%. 62% equity. The cost of equity is 11.7%. And the WACC is 9.7%. That's a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows right up here in blue. We also estimated a terminal value, which is all cash flows past year 4. That's $14 billion. And we estimated those numbers based over the prior financial information we input earlier. Now we have to discount those numbers back to today's dollars. And we discount them using the weighted average cost of capital. And that's in green right here, the discounted numbers. And if we sum them up, we get a value of the company of $11 billion. If we divide that number by the number of shares outstanding, 196 million, we get an intrinsic stock price of $58. It's trading at 75, so it's trading at a 29% premium. So it is a sell according to the model. It's went up so much today, the stock, it's now trading at a premium, according to my model. I think yesterday it was trading closer to my intrinsic value number, which is really interesting. Let's see what Simply Wall Street values the company at. They're at $108, so they're expecting lots of aggressive growth in the future for this company. My model only looks at prior financial information to estimate the future. Although I do have 4 models, and I did use the most aggressive model, so the model I used assumes the greatest growth rate for their future cash flows. If I used my other models, it would have been much lower, the calculated stock price. But even with my most aggressive model, it's still below what they're trading at. That doesn't mean they're not going to go over $100 a share or even $1,000 a share. Nobody can predict the future. But I just used the past information to figure out the future. It's kind of like if you have a friend that never pays you back. You lend them money, you go to the movies, you pay for that ticket. They never ever pay for you. They never pay you back. And he asked you for $20. You're hesitant. You're like, you don't want to. You'll find a reason not to give them $20. Oh, I don't have any money. I just had to pay my mortgage. So you won't trust that person, right? What if you have a friend who always pays you back? Not only do they pay you back, they give you an extra $5 sometimes because they feel bad for borrowing money. You would have no problem giving them money, right? It's the same thing with the stock market. If a company has proven to me that they're reliable, they're going to provide good, positive returns, I'm going to probably invest in them, like Amazon, like Apple, like Microsoft. I'm really comfortable investing in these companies. I feel they're going to grow and they're going to provide good returns. But if I have another friend like Tesla that doesn't provide these reliable returns, I'm a little hesitant. I mean, I'm not saying you can't make money on Tesla because people make lots of money. I'm just a little hesitant. I'm not that comfortable investing in those friends. Let's see where the stock has been trading. So it's kind of crazy. The stock is just really driven up the past few months. And maybe people can mention in the comments, why is it going up so much? I can't figure out why. Let's look at the financial ratios to see if we get more information. They have a bad PE, a bad price of sales, and a bad price to book. So PE is stock price over earnings per share. And to get earnings per share, that's net income over shares outstanding. And they have a PE of 25. I like to see below 15. This indicates investors are willing to pay $25 for $1 of earnings. Price of sales is stock price over sales per share. To get sales per share, that's revenue over shares outstanding. They have a price to sales ratio of 11. I like to see below 2.5. This indicates investors are willing to pay $11 for $1 of revenue. Price to book is stock price over book value per share. Book value per share is equity over shares outstanding. They're at 7. I like to see below 3.5. This indicates investors are willing to pay $7 for $1 of book value. They have a good current ratio and a good ROE. So current ratio is current assets over current liabilities. That's great. They can cover their current debts. ROE is net income over equity. So they provide a 26% return to the equity holder. I like to see over 20%, so that's good. Interest coverage ratio 1.6. So they can just cover their interest payments 1.5 times. They don't have that much extra room to grow their business or pay a dividend. And really, you want to look at ratios comparing them to other companies in the same industry. That's how you get a better sense if the ratio is good or not. And I've done videos on AbbVie, AstraZeneca, Biogen, Johnson & Johnson, Eli Lilly, Merck, Novartis, and Pfizer. And Horizon is right here in the middle. If their numbers in green, they're better than the average. If they're in red, they're worse than the average. So in terms of PE, they are better than the average because the industry has a 28 average, which is pretty high. They're at 25. In terms of price to sales, they're worse than the average. They're almost double the average. Average is 5.5, they're 11. Biogen is the best in price to earnings and price to sales. And in terms of price to book, they are better than the average. Even though I said they have a bad price to book, they are better than the average of 9.1. Eli Lilly is 60, so they're really dragging the average up. Current ratio, they're better than the average. ROE, they're worse than the average because Eli Lilly is 319%, so they're really dragging up the average to 46%. Debt, they're 38%, which is better than the average, so that's good, they're low in debt. And they're by far the smallest company. They're in an industry with massive companies, lots of $100 billion market cap companies like AbbVie, Johnson & Johnson, Eli Lilly, Merck, Novartis, and Pfizer. So it looks like the stock is headed for lots of big gains this week, and I'll show you why. And this is today's article on this company, and they're saying Horizon Therapeutics reported better than expected financial information. The best way to get big stock gains is to beat the expected results. And it's kind of crazy because the company recorded an $80 million net loss. And the reason is because last quarter the company projected $200 million of revenue for 2020, and it just recently updated that number to $650 million. So investors are really excited about this big growth. Doesn't mean they're going to turn that money into profit. That's when you really grow your company, not when you just make sales. But let's see how it goes. I'm not too convinced on this stock, but let me know what you think in the comments. Thanks for watching.